Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I am Michael Bull. Thank you for joining us today. Well, the show today is brought to you by C5 Global Summit. This is CCIM's Global Summit. It's an incredible event. It will be September 17th to September 19th this year. It's in Hollywood, Florida. You got to go, and I will be there. So look me up. I will be there in Hollywood, Florida. What a great place to be in September. If you'd like more information, visit c5summit.realestate. Well, today we're going to talk about real estate. What else? We're going to talk about retail real estate, one of the funnest sectors. We just finished Recon's, the big event for ICSC in Vegas, and everyone was there that's in real estate. And what an exciting time for retail folks. The retail market has been just overall seemingly doing very well. You know, we're headquartered in Atlanta, and it's like the retail here just seems to be just doing extremely well. Of course, you have the pockets of maybe a couple old malls and things that are still struggling, but even those are starting to get redeveloped. But what's really happened around the country? What are rates really doing? How about cap rates with rising interest rates? How about sales velocity, new supply? What's going on? Let's find out. Please welcome my guest. It's Jim Costello. He's Executive Director of MSCI Research. Jim, good to see you, sir.
Hey, nice to be here.
Well, great. Well, first of all, we're talking about retail. I guess it depends on where you live and what you're looking at or what you own. But overall, how is retail really performing right now, Jim?
Yeah, the property sectors that are recovering from the decline in sales volume that we saw in 2023, retail is one of the better performers in that sense. Total deal volume for April was down 11%. So it's still down from a year earlier. It's still sliding. But there's some sub-parts of some sub-components, sub-property types in retail that are doing better. Shopping centers, deal volume there actually grew in April from last year. And it wasn't like a one-off event of a big portfolio sale or some corporate M&A type deal that drove it. It was just people hitting singles and doubles, buying individual shopping centers one at a time, underwriting the risks of the tenants and the buildings and the submarkets. That's driving activity. And it's up. And it kind of makes sense to me that it's up because property income is growing for these centers. You had a situation where we were over-retailed for a long time. We built way too much retail in the 70s and 80s through the 90s. And we had big empty spaces in parts of the retail world. Some of that material, some of those assets have been removed from the market. They had to plant with a bulldozer. They've been converted to other uses. And that's helping the bottom line for the existing properties, the surviving properties. And you combine that with consumer spending, shifting to a lot of experiential and service-oriented stuff. You got to do that someplace. You can't get your nails done online. And so, the shopping center world is doing a bit better. Plus, the shopping center world, it's not like the other components of retail that are doing poorly at the moment. The shop space, that's more the triple net lease type assets. That activity, when you have inflation picking up, there's no way to really increase income except once you get a chance to release the space. So those investments just aren't trading as frequently as the stuff where the income can grow as the market changes.
Yeah, that's a good point. We saw a lot of single tenant net lease, and sometimes some of those leases are flat with no rate increases, and a lot of them only increase every 5 years. So good point. So if interest rates go up on those, obviously that's going to impact the value, but more of these multi-tenant will have annual increases, so things can keep rolling, right?
Well, yeah, and for a while when inflation was low and there's a little investment in a lot of things and interest rates were low, some of those triple net retail properties look great as investments. They were just kind of a little bit of a corporate bond tied to the tenant with a depreciation element for the property. But, that game has reversed course.
Yeah, it's always fun and interesting as you go through these cycles, and you and I have been through several of them at this point, right? Is how resilient, though, the single tenant net lease market is. The tenants usually are very stable, right? Tenants, they're drugstores at QSR, so they could be stable, but yeah, it makes sense that the volume is down. What about new supply, Jim? What do you see there with the rising rates? Is new supply down compared to historic levels?
I have not taken a look at construction of late. We did an analysis of construction lending last month, and there are still some lenders providing capital for retail construction, just not as many as before. And it's just not as easy at this point as just 2 years ago, given the change in the rate environment. There is just less debt available at the kind of low rates that developers need to move projects forward.
Yeah. What's interesting here in Atlanta, we have some retail tenant reps that help businesses with space. And, all I'm hearing from them is they're having trouble finding great restaurant sites and retail spaces for a lot of these tenants. And the landlords are getting, when they do have an opening, multiple offers. Are the rates overall, rental rates on retail, do you see them increasing? What rate do you see them increasing at this point?
We're not tracking the leasing rates. We are tracking property NOI across sort of the institutional portfolios, where the owners give us their appraisals every quarter so we can build our index of market performance. Those appraisals, when we look at all the NOI on a same store basis, retail NOI is now 8% higher, the level of NOI, than before the pandemic. So, we've wiped out the problems of the pandemic. That's all in the past. We don't have to worry about it anymore. Forget about social distancing, the masks. That's all in the past. And income's higher than before. So, the problem is that, interest rates are higher and cap rates are higher. So, on balance, some of the equations, some of the math doesn't work out for supporting prices. But you've got some good income in place because you have some stability in the economy and households that are willing to spend. So, which would you prefer? Low interest rates and a weak economy, or consumer spending but rates a bit higher? That between the two, there's a little bit more stability, and just knowing that your fundamental customer base is willing to come to your facility.
Yeah, I prefer normal historic interest rates because I think if interest rates are 0 to 1%, there must be a problem somewhere. Right?
Exactly. That's not a sign of a healthy economy. That's a sign of an economy where there's so little demand for capital that they just have to reduce the price. Nobody's investing, nobody's growing. And that's what low interest rates really were a sign of. The fact that they're higher now, yeah, there's an inflation element to it, but there's also an element to it where we have people trying to invest for growth, and that is just causing some competition for capital.
Yeah. And, talk about the strength of retail and NOI and values of these properties and interest rate changes. It makes one think about, cap rate changes. And obviously, retail property cap rates have gone up, but it may surprise people that the cap rates haven't gone up that much when compared to how much interest rates have gone up, right?
Yeah, and taking a look at our simple average of cap rates, just the average of what happens to transact, it went up about 50 basis points over the last year in April. But most of that increase started in 2023. It's been almost flat for 2024 so far. Now, this change, some of it's in response to the increase in the interest rate environment and the increased cost of debt and everything else from the interest rate shocks. But then if you have income growing as well, that can help to moderate some of the increase in cap rates. So cap rates, yeah, they're at 6.9% for April. That's definitely higher than we were in 2023 at the low point, getting close to 6.4 or 6.3. But it's something that you have the increase in interest rates that was much sharper, but they never move in a one-to-one basis because you do have that income element. If you can boost your income at the property level, then that becomes more valuable. So that helps to decrease cap rates. The interest rate environment, that helps to increase them. And if the two are moving against each other, then you're not going to have a one-to-one move in cap rates with interest rates.
Yeah. One of the things we're seeing in our market here in Atlanta, where we're headquartered, is new supplies is almost stopped, except for mixed use developments, right? And there's not enough of those is going on, and that seems to be really strengthening the market here. Yeah, what do you see overall that's really helping retail around the U.S.?
Yeah, retail development, that's interesting to me, this notion of the mixed use projects. So the benefit that you're delivering there is that you're bringing not just a retail property, but you're bringing those tenants who would occupy the space, you're bringing them a natural client base, just the people who live nearby, kind of capturing the old city center kind of concepts and just having everything in a walkable location nearby. So that is a formula when it works that could be lucrative for the developer and the ultimate tenants.
Yeah. And you mentioned consumer sentiment. It seems like some folks are concerned that consumer spending could slow down, but it really hasn't, right?
Yeah, consumer spending, at some point, it should really just grow in line with personal income. You can't over the long run spend more than you take in, unless you're the federal government, but that's another topic. Uh, but the we had a burst of period of stimulus that went into everybody's pocketbooks during the worst parts of the pandemic, and there's some lagging impact of that as people were spending out of all that, and then people were spending some of their savings in a revenge spending tour that happened as the pandemic was coming to an end. Once you get past all that, that should start to slow down and grow a little bit more in line with personal income. So that is an issue that people have to be concerned about.
And as the Fed tries to continue to bring down inflation, might that hurt the job market? And does that impact retail?
Yeah, the consumer spending element on that, one of the biggest increases in the inflation numbers for the month came from car insurance, up almost 20%. And so if suddenly your insurance has cost a lot more on your car, you're going to have less money to go spend at the Waffle House or someplace else. So you've got some impacts on that side from the pricing side of the economy that impacts people's bottom line in terms of what they're able to spend. So then if we go the other way and just take a look at will the high interest rates and the Fed not cutting, is that going to cut off job growth? At the moment, there's still pretty decent job growth. So it's hard to see how that side has an impact yet.
And as far as car insurance goes, so did you sell one of your 20 cars? Are you down to 19 now? Or,
I have an incredibly expensive electric car. It's called the MTA. I ride one of those here to my office at the World Trade Center every day when I'm on the road.
And you're in a mixed use environment already.
I'm in a mixed use building. I am one of those tenants. I love cooking, but I have a very nice food hall in the basement of my building, and I don't cook as much now because I got to know all the chefs at some of the restaurants in the place. And it's kind of nice to just walk in at the end of the day and they know you, and they got you.
Yeah, it's awesome. I'm the same way. I have a home on Lake Lanier here, which is like a 43-minute commute from my office, and have a place in town in a mixed use environment. And to your point, I'm the same way. I love it. Just go downstairs and pick where I want to have a drink or have some food. It's just wonderful. Well, Jim, what would you leave our audience with to think about for retail moving forward?
Retail was the sector that for a number of years, it was the redheaded stepchild for commercial real estate investment. People were always bashing the retail sector and saying that it was dead. Nobody wanted to be in retail, but that's starting to change. Sadly, for office investors, it seems like that's the sector that's getting a lot of the hate at this point. So, retail, we've seen the demolition and removal of older properties that just weren't as efficient. That's helping the bottom line of the survivors. And in some sense, for those folks in the office market who are now getting all the grief, look to the performance of retail as a guide to what you might expect.
Yeah, good point, because it was really in the dumps for a while, right? And look how it came back. And when I think of retail, though, typically it's good real estate, meaning it's main and main, or it's flat, it's clear, it's got utilities, so it really opens itself up for other uses, doesn't it? And office is a little tougher with that typically.
Well, yeah, I mean, some of the retail, it's not going to be in many cases the highest quality build. Some of it's going to be just some big box type development. And if you need to redevelop it because the tenant base and incomes have changed in the area, you don't have as much of an embedded value as, say, an office tower in the urban core of a major city. It's harder to do a redevelopment on because it's not as easy to tear it down and start over in the city, as opposed to a big box that used to house a category killer retailer. Much easier to scrape that and start over fresh with something new on that site.
That's a good point. And the haters are going to hate, right? So office is the one that is in the doldrums today. But hey, if any listeners are interested in selling office or investing in office, please call me. I think office is going to come back like retail did. I think within 5 years, I think we're just going to be surprised, because I think the new supply is going to slow down or stop, and demand's going to continue to increase. Some buildings are going to get torn down, some converted, no new supply. Some employees and employers are going to realize the benefits of being together. Offices are going to be nicer. I think it's going to change, but not many people agree with me there. That's
why there's a market, because not everybody has the same ideas on things. And eventually, we kind of figure out where the desire lines are, and prices and demand change.
Yeah. What's interesting, we are seeing a lot of users that we're working with buying office properties while they get in such an attractive basis. But here we are, changing sectors. Jim, thank you for talking to us about retail. Appreciate the information. Thank you for being with us.
Thank you.
All right. And thank you for joining us around the country. Hey, let us know your thoughts. We appreciate you sharing the show. Please reach out to us. Hey, if you need anything from me, my email is an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. And by Lument. For senior housing, healthcare, and multifamily financing, visit lument.com. For more podcasts and videos, subscribe and visit CREshow.com.